The real difference between people who quietly become wealthy and those who remain financially stressed is not intelligence, luck, or even income level, but how money is allocated the moment it arrives. When a rich thinker receives income, the first question is not what to buy, but where that money should be placed so it can grow. Wealthy thinkers treat money like employees that must work, not like rewards meant to be consumed. The same paycheck can either disappear or compound depending entirely on direction, not size. Imagine two people earning the same salary of $3,000 per month. Person A spends $2,700 and saves $300 irregularly. Person B spends $2,200 and automatically invests $800 every month. If person B invests $800 monthly at a modest 8% annual return, after 20 years that account grows to approximately $475,000. Person A, saving inconsistently and holding cash, might accumulate less than $40,000 in the same period. Rich thinkers pay themselves in assets before paying for comfort. The income was identical. The allocation created the difference. Poor and middle-class habits often use money emotionally, as relief, reward, or proof of progress. A stressful week justifies spending. A small raise justifies a lifestyle upgrade. When money is used primarily to soothe emotions, it loses its ability to multiply. Rich thinkers feel the same urges, but they delay the relief. They understand that every dollar spent for temporary comfort is a dollar no longer available to buy future freedom. Consider a simple car decision. One person buys a car for $35,000 using a 5-year loan at $700 per month. Another buys a reliable used car for $12,000 with a $250 monthly payment and invests the $450 difference. Investing $450 per month at 7% for 5 years results in about $32,000. At the end of 5 years, the first person owns a depreciated vehicle worth maybe $12,000. The second person owns a car and nearly $32,000 in investments. Rich thinkers are careful with liabilities because they know every fixed expense reduces future flexibility. Housing reveals the same pattern. One household stretches to a $300,000 home with a $2,000 monthly payment. Another chooses a $200,000 home with a $1,400 payment and invests the $600 difference. Over 25 years at 6%, that $600 monthly investment grows to roughly $420,000. Wealthy allocators understand that controlling expenses is more powerful than increasing income early on. The smaller house quietly buys financial independence. Allocation order matters more than income size. Rich thinkers allocate to growth first, protection second, and lifestyle last. Middle-class habits often reverse this order. The order of allocation matters more than the amount being allocated. Even investing $200 per month starting at age 25 can grow to around $530,000 by age 65 at 8%, while waiting until age 35 requires more than $450 per month to reach the same result. Rich thinkers also allocate money towards skills and leverage, not just investments. Suppose someone spends $2,000 learning a skill that increases their income by $500 per month. That is $6,000 per year in added income. Over 10 years, that single skill produces $60,000 from a $2,000 investment. Money spent to increase future earning capacity is not an expense, it is an accelerator. Poor and middle-class habits often hesitate at education costs, but freely accept depreciating purchases without question. Risk is handled differently as well. Poor thinking avoids risk entirely. Middle-class habits accept visible risk, and rich thinkers calculate exposure. Wealthy thinkers avoid reckless risk, but embrace calculated exposure. $700, while cash quietly shrinks under inflation. Time horizon widens the gap dramatically. Poor and middle-class habits allocate with short-term thinking, while rich thinkers think in decades. Rich thinkers invest as if their future self is a business partner they deeply respect. A single $5,000 investment at age 30 growing at 8% becomes nearly $50,000 by age 65 without adding another dollar. Social pressure distorts allocation for many. Middle-class habits chase visible success, while rich thinkers measure progress privately. Rich thinkers allocate money quietly and measure success silently. They track net worth, cash flow, and ownership instead of appearances. Debt further exposes allocation differences. Poor habits use debt to survive. Middle-class habits use it for lifestyle. Rich thinkers use it for leverage. Rich thinkers separate bad debt from productive leverage with ruthless clarity. A loan that produces income is evaluated differently from one that only creates obligation. Unexpected money reveals financial identity instantly. A $10,000 bonus spent disappears. Invested at 7%, it becomes $19,700 in 10 years. Windfalls reveal financial identity more clearly than income does. The money itself is neutral. Behavior decides its fate. Consistency beats intensity every time. Rich thinkers build automatic systems. Wealth is built through consistency, not moments of motivation. A boring $300 monthly investment outperforms sporadic large deposits fueled by emotion. Even attention is allocated differently. What you pay attention to financially shapes what you become financially. Rich thinkers study numbers without fear, while poor habits avoid them entirely. At its core, the difference is identity. Poor and middle-class habits see money as something that happens to them. Rich thinkers see money as something they direct. When you believe you control allocation, you take responsibility for outcomes. And once that belief locks in, income becomes secondary. Rich thinkers win the money game not by earning more first, but by allocating better first. Over time, better allocation creates higher income, stronger security, and freedom that looks sudden from the outside, but feels inevitable from within. The real divide between rich thinkers and everyone else is the ability to delay gratification in exchange for permanent leverage. Once that mindset is installed, money stops being stressful and starts becoming cooperative.